Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman & Wakefield's #1 investment sales team.
So with that being said, so where are we in the cycle? You and I like to use, innings, like baseball game example. There's some people we talk to who still think we're 9 years into the run up from the Great Recession. But where our perspective is we're 25 months into this recovery, but where are we relative to the cycle?
Yeah, and I think a lot of the perspective depends on what sector of the industry you're in. If you're a multifamily owner or an office building owner, I think you say, you know what, we're still in the cycle. The market didn't change in the fourth quarter of 2015. We're in this long drawn out, when is this going to end? I think generally from our perspective, looking at the market very holistically, looking at the entire market, I think that we are probably in the 7th or 8th inning of this correcting market. And I think it's going to take through the end of the year, maybe into the first quarter of next year, to flush out the gunk that we need to get through. But there are many positive signs around the fringes. So I expect that we could potentially be back into a bull market by early next year.
Okay. Let's maybe shift to some of the perspective and investor sentiment that we've been getting kind of in real time and over the last 6 months, let's call it. One of those questions is, given the new supply of residential that's still coming online, especially in some markets like downtown Brooklyn, Long Island City, and even in Manhattan, some neighborhoods, particularly downtown, how are investors underwriting growth for residential today?
Well, and this question gets to not only multifamily, but all sectors.
Sure.
How are investors underwriting growth in retail, in office, in residential? And I think it depends on whether they want to buy property or not. I think no model, I've never seen a model that projects flat rental growth or negative rental growth done by someone who actually bought a property. So I think if you're not optimistic and you're not projecting rent growth of some type, it's very challenging to buy anything because you're just not going to come out at the end of the day with the pricing that you want. So I think that investors are more conservative with their projections on rental growth today. But if you're not projecting some type of rent growth, you're just not going to be competitive in terms of being a buyer.
Okay. So one of the other markets, a lot of focus on Long Island City. There's 20,000 new apartments in development or being planned right now. How do you think that spillover effect will happen to the rest of Queens, the rest of the market, and what impact that will have?
Okay, well, I'll give a macro answer and then a micro answer. The macro answer is that most major markets across the country replenish about 5 to 7% of their stock every year. In other words, you have new housing starts of 5 to 7% of the total market, and that's average across major cities across the country. In New York, it's like 1%. So if we have population growth the way population growth is expected, I don't believe we have oversupply. Now that's the macro answer. The micro answer is that this new supply does impact the market, and we have people moving from location to location depending on what kind of deal they think they could get on their apartment. It just blew me away when people were priced out of Williamsburg and were moving back to the Upper East Side because rents were lower on the Upper East Side than they were in Williamsburg. In the same way, I think Long Island City is going to draw people from areas with higher rents where they can get a lower rent and still have a relatively easy commute, and that's going to impact, that will spill over into surrounding areas too, because as more people come into the market, you get better retail, you get better amenities in the area, more people want to move there, then it spills over into the Class B and Class C properties. So even if we get half the population growth that's being projected, these units will all get absorbed relatively easily.
Okay, so it seems like for a lot of investors that we've been speaking to, cap rates and projected IRR returns are converging. Do you think that's more of a result of lack of rent growth or projecting a higher terminal cap rate in the end?
Well, again, I think it gets to the feasibility and realities of modeling. Yes, if you look at numbers, we're seeing some IRRs that are in the single digits, which we've never seen before. And that's a combination of muted rent growth in the projections. If some investors are being realistic and say, hey, we're going to have 0% rent growth for 2 years, and then it'll be 1, and then 2, and then finally 3. And you raise your terminal cap rate by 25 or 50 basis points, it's going to have a very negative impact on your IRR. So transactions that are subject to that type of underwriting are not being bought by IRR investors. And a number of the multifamily properties that we're selling today, we're selling to investors who I don't think even know what an IRR is. They're buying their family offices, they're high net worth individuals. They're looking at an asset and saying, this is a type of asset I'd love to own 20 or 30 years from now, until the IRR is meaningless. If you're IRR driven, it's very, very challenging to hit your numbers today, particularly if you're being realistic with your rental growth and your terminal cap rates.
This is a question I've had heard other people ask before, but do you foresee year-end bonuses impacting bidding activity throughout the rest of the year?
Well, that's an interesting question, and I'm glad somebody asked that, because you look at motivations for what make folks do things, and sometimes there are these types of motivations. I mean, we've had funds that have overpaid significantly for properties simply because they needed to show some activity. We've had folks who were in the fundraising process and needed to show activity, so they overpaid for something. We had a couple of years ago, we had a client who overpaid wildly for something because they were afraid their investors were going to pull the money back because they hadn't bought anything in a while. So could year-end bonuses be affecting bidding activity? Absolutely could. I think that's something that comes into play, unfortunately for those investors, fortunately for us because it creates some activity, but I don't think that's very widespread. I think that's on a case-by-case basis and happens every once in a while, but is not really anything that's going to profoundly impact what happens with activity in the marketplace.
So with everybody that you speak to day in and day out, so what are investors forecasting for what they think 2018 is going to look like in the next few years after that, 19 and 20?
Well, I think nobody really knows. I think that's why there's so many folks here today. That's why we look at these numbers and try to scrub them and grind them and figure out what's going on. And what we look at on a week-by-week basis of all the properties we're selling, what's the activity like? Who's bidding? Who's interested? Where are these people coming from? What's their motivation? Why are they doing what they're doing? And that gives us a sense of the market. And so from that perspective, I'm very optimistic because we're seeing very, very positive trends in all these things, of the amount of interest we have, the number of tours that we're having on properties, the amount of bids, the level of those bids, where these investors are coming from, the fact that you have a great balance of foreign capital and domestic capital and institutional capital and high net worths and families. There's a lot of very positive signs out there. I think for the most part, the general investing community is relatively bearish on 2018, which is why we see volumes continuing to be down, because they're not stretching, they're not overbidding, they want to be very careful, and that's completely understandable. But I think that we see the trends a little bit ahead of the curve, and I think that by the middle of next year, I expect the market to be in a very, very different psychological state than it's in right now.
So let's pivot to talk about maybe just lending environment and interest rates right now. One thing that you've always argued is that the low interest rate environment really sparked the recovery from the Great Recession. What are you seeing today in the market, and what's the impact that the interest rates are playing still today?
Yeah, well, again, I think low interest rates are something that really fuels the market. It's like kerosene, or I use the analogy a couple of times that it's the heroin for real estate investors, and I probably shouldn't have used that because I got a little bad press about it, but low interest rates totally make the market. If you look at, this morning, the 10-year will open at 230, the 5 years at 149, I think that the increases that we've seen in those rates, particularly the 5-year, is something that is a little bit concerning, but lenders have compressed their spreads, so that's not all being passed along to the investor. And financing is still relatively plentiful. I think one of the good things about this run-up, and you've seen the values, from trough to peak, we see value increases of 120%, 150%, 170%. Even in that environment, lenders have not gotten overly aggressive with their loan to values. There's still a lot of equity in transactions. Lenders are very, very healthy. Default rates are down. So I think that you have a lot of capital available. You have CMBS lenders that are very, very active. They're doing 10-year IO deals today. Community banks, particularly if you're buying multifamily, very, very aggressive, not so aggressive on loan to value, but they'll give you money at 350, 375. Construction lending is coming back at relatively reasonable rates, LIBOR plus 550, 575. And LIBOR is, I think, 49 basis points this morning. So if you look at these trends in lending, plus you layer in the alternative lenders that have come into the market to provide either mezz loans or preferred equity, there's a lot of money available out there for the right transaction. I think a lot of platforms, in the last cycle, you saw a lot of alternative lenders getting into the market on a loan-to-own basis. This time, I don't think it's loan-to-own. I think they want to make loans and just get a good yield on their capital. So, the amount of capital that's available for investors today is really significant, and the lending market, I'd say, is very healthy.
And what happens in the near term? Interest rates rise significantly.
Well, that's a question. We got that from a lot of folks.
Yeah.
What happens to the market if interest rates go up? And I say you have to assume interest rates are going to go up. I mean, we've been 8 or 9 years now where rates have been effectively zero on a federal funds basis. That's very unusual. Rates are going to go up, but the big question is not what happens if rates go up. The big question is why rates go up. If rates go up because the economy is stagnant and we're not able to sell our bonds the way we've sold our bonds in the past, that's a problem. That's a very, very big problem. If, however, interest rates go up because the economy is healthy, we have good job creation, we have good GDP growth, that's a good problem. And that doesn't necessarily mean that because rates go up, over the long term, interest rates and cap rates are very highly correlated. And to the extent that interest rates go up, cap rates should go up. But that doesn't necessarily mean values go down, because if we do have a very robust economy, then net incomes will go up. And that increase in net income will more than offset the rise in cap rates, so ultimately values will be higher. So the big question when it comes to interest rates is not if, but why. And so we won't know the why until after we see what's going on, but we need to know why they go up, and that'll dictate whether that's a good thing or a bad thing for real estate. It's not necessarily a bad thing.
Okay, let's maybe pivot to some legislative issues that we've been talking about, had some questions on. So it appears that Mayor de Blasio will win a second, be reelected this year. So many of the questions have been regarding specifically what can the industry do about specific organizations like DOB, HPD, DHCR. What are your thoughts about what de Blasio's second term could mean for the real estate market?
Okay, well, a couple of points on that. I think that clearly one of the problems that we have is that the mayor doesn't want to be our mayor. He wants to be the president. That's why he's flying around the country, flying around the world, giving speeches. He wants to be the president of the U.S. He doesn't really want to be mayor of New York. And I think that's a big issue, because I think a number of the things he's going to do are going to be initiatives that are going to give him talking points for his presidential campaign in 2020. So that doesn't really bode well for us here in New York. Number of issues that we could talk about. Mostly, I think his policy will have a negative impact probably on multifamily more than anything. I think that he said he was going to implement a rent freeze. He implemented that rent freeze. To have another rent freeze is not going to be big news or headline grabbing. So I fully expect that what we'll see is a big effort on the administration's part to re-regulate hundreds of thousands of units in his second term. I don't see any other way that he's going to be able to make a big impact, appeal to his base. I think that's a concern. I think that's also one of the reasons why many multifamily investors are really focused on free market units. And maybe free market units that weren't freed up in J51 buildings, maybe new construction. I think new construction in residential is going to be a very, very significant thing that will be very appealing to investors because there won't be any cloud over whether those units could in fact be re-regulated. But I think if you look at what's going on with the Department of Buildings, it's a labyrinth of trying to get anything out of there. It's frustrating the industry very significantly. The affordable housing is a huge issue for the city, and it's really hocus pocus math that has the administration saying they've created the amount of affordable units they have. I think the way they do their math, if HPD makes a loan on a building, they say, oh, we preserved all those units. So I think, affordable housing is a huge issue. But I think we have to just slog through. We have to keep fighting the fight, talking to local politicians about what is important for us. We need organizations like REBNY and RSA and CHIP to continue to do their things and try to fight as hard as possible to preserve some level of sanity within our industry.
Okay, let's move on to less depressing topics. So, affordable New York, the new version of 421A, how is that affecting the land market, especially particularly I think in the outer boroughs that it has more impact than it will in Manhattan?
Yeah, well, Affordable New York, which essentially is the new iteration of the 421A program, I think it's overemphasized in terms of the impact that it has. And this time around, this iteration really applies much more to rental buildings than condos. Any condo building over 35 units is not subject to this program. It's had an impact, but not a significant one. I think that if you look at the market turning down, the land market in the end of the third quarter of 15, 421A was still around. Now the new Affordable New York went into effect in April. It's only been the last 4 to 6 weeks that we've seen an uptick in the land market. So I think it's great. It's probably a better iteration of 421A than we had last time. But it's positive, but not earth-shattering in terms of the impact it's going to have on the market.